Hi, I'm David, and welcome to the channel. Today we're talking about something that trips up more retirees than almost anything else that I see when we're planning for them. It's not about how much you've saved, it's about understanding what that number actually means, and more importantly, what it actually doesn't mean. Because here's what I've learned over 25 years of working with individuals and families approaching retirement. Two people can have the same exact net worth and live completely different retirements. One might retire confidently, spending comfortably and feeling in control, and the other stressed, anxious, having uncertainty, constantly wondering if they're going to run out of money, even though they have just as much saved. So you may ask yourself, what is the difference? It's not luck, it's not the market, and it's not that one person just got better advice. It's structure of your investment accounts. And today I'm going to walk you through exactly what that means and why net worth by itself is one of the most misleading numbers in retirement planning. So let's start with a scenario many of you might recognize. You've been saving diligently for decades. You've hit your number. Maybe it's $1 million, maybe it's $1.5 million, maybe it's $2 million plus. You look at your statements and think, okay, I did it, I'm ready. I have enough money. But then something happens. You sit down to actually plan out your retirement income and the numbers just don't feel right. You run a few calculations, you think about taxes, you consider how much of your Social Security will cover your desired income, maybe you have a pension, and suddenly that big number you've been working towards, and you ask yourself, do I actually have enough? And here's the one thing, that feeling is completely valid, and I've seen it 1,000 times, because net worth doesn't tell you what you need to know. Net worth is a snapshot, retirement income is actually the strategy. And those are two very, very different things. So let me give you a real world life example, not from a specific client, but a pattern I see all the time. We're gonna talk about household A and household B. Each household have $1.5 million in retirement savings. On paper, they look absolutely identical, but here's how their situations actually break down. Let's start with household A. They have $1.5 million. All of it in a traditional pre-tax retirement account, either IRA or 401k. No Roth, no after-tax or taxable brokerage. They have $250,000 that's owned on a mortgage with about 12 years left, and they have minimal Social Security because they retired early, let's say at 62. Household B has about the same $1.5 million, but it's broken up like this. $600,000 of that $1.5 million is in traditional pre-tax retirement accounts, either 401k or IRA. They have $400,000 in a Roth. They have $300,000 in taxable brokerage accounts, after-tax accounts, and they have $200,000 in savings. No mortgage, and they have moderate Social Security. Same net worth, $1.5 million. But when we model these out over a 25-year retirement, household A is going to face some real challenges. Number one, taxes, because every dollar they pull out of their $1.5 million, because again, all of that money is in pre-tax retirement account, either 401k or IRA, and they're paying a mortgage, their withdrawal rate is higher than it should be just to cover their fixed expenses. And depending on how much they need to take out, they could push themselves into higher tax brackets, triggering IRMA surcharges on Medicare premiums, potentially reduce the longevity of their portfolio because taxes are eating into their distributions. Now let's talk about household B. They have complete flexibility. They can pick and decide and choose when they're going to get their distributions because they have multiple accounts they can pull income from. They can pull from their taxable account in low-income years to stay in a lower tax bracket. They can tap into their Roth for tax-free income when needed. They don't have a mortgage payment eating into their monthly budget. And their overall tax bill significantly lower, which means more spendable income, even with the same starting balance. Same net worth, completely different outcomes. So if net worth isn't the full picture, what should we be looking at? Here are 3 factors that really determine how your retirement feels and how long your money lasts. So let's talk about factor number 1, and this may be the biggest one, tax diversification. And again, this is a big one. If all of your money is in pre-tax accounts, whether it's 401k or IRA, your traditional IRA, every dollar you take out is taxed as ordinary income. And here's what this potentially means. Higher tax bills in retirement. Potentially your Social Security is taxed more. up to the maximum of 85%. Potential Medicare premium surcharges under IRMA. and very limited flexibility when the unexpected happens. If you're in retirement and you need a new roof, or you want to help out your kids with a marriage or a down payment in a house, and all of your net worth is in pre-tax retirement accounts, $20,000 or $50,000 one-time distribution could jump you into a much higher tax bracket and create more taxes on Social Security. Now, I'm not saying pre-tax investments are bad. They've been great wealth building tools for many for a long period. But balance matters, and more importantly, tax flexibility matters. It allows you to manage your taxable income year by year. It gives you flexibility and control, because pulling from the right bucket at the right time to keep your tax bill as efficient as possible is crucial to making your money last for the rest of your life. And over a 20 or 30-year retirement, that efficiency could potentially mean hundreds of thousands of dollars in savings, and that's a big deal in retirement. Now let's talk about factor number 2, fixed expenses. The second factor that people overlook is how much of your monthly income is already committed to fixed expenses, like a mortgage or a car loan or other debt. That's money you have to withdraw every single month, whether the market is up or down. And if a big chunk of your retirement income is locked into fixed payments, that reduces your flexibility, can increase the risk of over withdrawing during down markets. Now, I'm not saying you need to be completely debt-free to retire. Now, you should understand how those fixed obligations impact your withdrawal strategy and overall cash flow. For some families, paying off a mortgage early creates peace of mind and reduces monthly pressure. For others, keeping a low mortgage balance and investing the difference makes more sense. It really comes down to what your interest rate is on your mortgage. If you have a 2.5% interest rate, but your investments have been averaging 4 or 5 or 6, maybe it doesn't make sense to pay off your mortgage. But if you are at a 5 or 6 or 7% interest rate, it may be a good strategy to pay off your mortgage right as you approach retirement. Now, here's the thing. There is no universal answer, but there is a need to plan around it intentionally. And factor number 3, your withdrawal strategy. And finally, how you take money out matters just as much or even more than how much you've saved. Are you pulling from the same account every year? Are you coordinating withdrawals to minimize taxes? Are you planning ahead for what your RMDs may do as far as increasing your tax burden and moving you into a higher tax bracket when you're 73 or 75? A coordinated withdrawal strategy can help you stay in lower tax brackets longer and avoid unnecessary Medicare surcharges, preserve more of your portfolio for future growth, create more spendable income without increasing risk, and potentially leave money behind more tax efficiently to your heirs if legacy planning is important. This is where real planning pays off, because two people with the same portfolio can end up with very different retirement lifestyles depending on whether you have a strategy or if you're just reacting to it year over year. Now, let me bring this back to something tangible. Let's say you have $1.5 million saved and you're planning to retire next year. Scenario 1, you have no coordination. You start pulling $60,000 a year from your 401k or IRA, add in Social Security, maybe some pension income. Your taxable income is now pushing you potentially in the 22 or 24% tax bracket. You're paying income tax on your withdrawals. You're paying income tax on your Social Security. And depending on your total income, you also may be paying an extra $2,000 or $4,000 a year in Medicare premiums due to IRMA. After 10 years, you've paid tens of thousands of dollars in taxes that if you had a better withdrawal strategy, you might have been able to reduce that or avoid that. And then when you look at that money that could have been growing over that time period, that is a huge difference. Scenario number 2, a coordinated strategy. Same $1.5 million, but now it's spread across different accounts. You take $30,000 from your taxable account, much of which might be tax advantage due to capital gains treatment, either at 0% tax bracket or a 15% tax bracket. You pull 20% maybe from your Roth. You take 10% from your traditional. Now your taxable income is more manageable. Your Social Security is taxed at a lower rate or potentially not even being taxed at all. And you completely avoid IRMA, those unnecessarily premium hikes on your Medicare premiums. And your tax bill, a fraction what it was in scenario 1. Same net worth, same spending, completely different tax outcome. So why does this matter today? Because if you're within 5 to 10 years of retirement, or you're already there, the window to make structural changes is closing. And with the big, beautiful bill recently extending the 2018 Tax Cuts and Jobs Act, we know for sure we're at least in these more favorable tax rates for the next 3 years. And once you're in retirement and taking distribution, your options narrow. So if you're still working, you have time to build Roth balances strategically. Consider Roth conversions, especially if you're going to be in lower tax years now versus retirement. Pay down high interest debt and reposition assets for tax efficiency. Look, if you've already maxed out your pre-tax retirement accounts and you have extra income to save, look at after-tax accounts, because again, after-tax accounts could have a more favorable distribution rate as far as taxes 0, 15, and 20 than your ordinary income rates. If you've already retired but haven't optimized your withdrawal strategy yet, it's still not too late. But the sooner you start coordinating, the more you can potentially save. And here's the bottom line. Net worth is important. It's a milestone. It's something to be proud of, but it's not the finish line. It's actually the starting point. Retirement is no longer about accumulation. It's about distribution. And your plan has to completely change. Things are different in your 20s and 30s and 40s and 50s. You can take on more risk. You're saving as much money as possible. But when you go from accumulation to distribution, you have to think about tax efficiency, a withdrawal strategy. There's so much that more goes into it as you approach retirement years or when you're in retirement. It's about turning that nest egg into a reliable, sustainable, tax-efficient income stream that supports the life you've worked so hard to build and the life now that you want for the next 20 or 30 years. And that requires way more than just hitting a number. It requires structure, it requires coordination, and it requires a well-written plan that looks beyond the balance sheet and focuses on what really matters. How much can you actually spend? How long will it last? How can you do it with confidence? If you've never had a conversation with your advisor about withdrawal strategy, tax coordination, and how your assets are structured for retirement, this might be the most important conversation you can have with your advisor. Because at the end of the day, it's not about how much you have, it's about how much you keep and how well it works for you. If you'd like to walk through your situation, whether you have at least $500,000, 5 million, 10 million plus, we'd be happy to sit down with you and to help you see what your plan actually looks like in real time when you factor in taxes and withdrawals. And you can schedule a time with us using the link in the description below. We'd love the opportunity to have a conversation with you. Thanks for watching, and again, we'll see you in the next episode. If you're curious about how we help people protect what matters most in their retirement, and you just want to see how our process works for you, give us a call or visit our website at www.bamadvisorygroup.com. You can schedule a 15-minute, no cost, no obligation, no pressure phone call with one of our advisors to get all of your questions answered, to understand your options, and for us to be able to provide you with more information and clarity. And if you're enjoying the show, don't forget to like and subscribe. Thanks again for watching. We'll see you all real soon.